Hey everybody, welcome to another episode of the Business Barbershop Podcast. I am Chris,
I'm Keen.
and today we are going to talk about how to BRRR, not be cold, but BRRR like real estate in a high value market.
Yep.
Right?
Yep.
All right. This is Keen's not just area of expertise, also his idea. So I'm going to let him sort of take the show, and I'm just going to ask dumb questions.
No such thing. All right. So let's first just recap on what BRRRing is. Okay. Mm-hmm. So the concept of it has existed for a long time. And I think that similarly to things like house hacking or whatever, people come up with terminologies that become standardized, especially in the world of social media. So we have ways to explain it to people. But there's also a book written by one of the Bigger Pockets podcasters by the name of David Green. And the basic concept behind BRRRing is this. Let's suppose you buy a house for $30,000 in a certain market that's in just pretty rough shape. You're able to fix it up for the cost of, let's say, for a cost like $35,000.
So let's go through each one at a time, though.
Yeah.
The B is buy.
Yes. Buy. Rehab.
Right. So you're going to fix it up, put some money into it, $60K, let's say. Now you're $90K in, right? You buy for 30, in for 60.
Yep. And then you're going to rent it.
Okay.
And then you're going to refinance it. What they don't say in that refinance is the concept of it is that your refinance is a cash out loan.
What do you mean by cash out?
That means you're going to take out money from the equity of the property. And then you're going to repeat it. And the hope is, and what we call in the investor world as 100% BRRRR means that you're able to pull out everything you put into it. You pulled out the down payment.
Right.
You pulled out your rehab money. You even pulled out your holding costs during that rehab process, like while you're in a hard money loan. And so that way you basically get a rental with no capital into it. You had to front capital, but the capital you put into it, you got back out. Right. That's what 100% BRRRR is.
Does that... Okay, so before we get into your high value market strategy, with what we're talking about right now, though, that 90K, so the 30K purchase, the 60K rehab, that would be, in this scenario, all front loaded from you, essentially.
You can get hard money loans. That's the most common way people get into the properties initially. Mm-hmm.
Okay, but if you're doing the refi, though, you would be pulling that out, and that would be going to them. Back to the hard money lender, then you would just keep whatever the over. So the idea was you buy for 30, you put 60 into it, and now let's say it's worth 200.
Or let's say it's worth 200, and let's say after holding costs, you're into it for like 100 grand. Let's say you have 10 grand of holding costs, so you're 90 grand into it plus the holding cost of 100. It appraises for 200.
Right.
You refinance a new loan where you can basically pay off whatever hard money loan you do.
Let's say 125. Let's say you refi it for 125, you get like a traditional sort of a note on it, right? That 125 comes out back in your pocket. You take in maybe your 30 for the purchase price. You pay back the 60 to the hard money lender. You still have the extra 25 that you pulled out, and then you can sort of just go do the whole thing all over again.
Yes.
Essentially. And now you have an income producing rental property.
With equity.
So
a lot of people, when they first hear about the idea of BRRRing, they think, oh, people are over leveraging themselves with BRRRRs because you're putting no money to it. Permanent capital put into a property does not mean you're over leveraged. Over leveraged is relative to what you owe to what it would sell for. And also, I think that it doesn't technically define this, but I think this could be an aspect of it if it doesn't cash flow well.
Right.
And let's say you have 50% equity in it, which sounds like you have a lot of equity, but the thing negative cash flows, you probably have leveraged more than you should if it doesn't cash flow because now you got to pay to own the thing. So in a perfect world, a BRRRR is something where all the money you put into it, you get it back out. There's ample equity in it, which we, as a lender, we require there to be equity in the place anyways to be able to refinance and pull that money out. And it does cash flow fine and positive, servicing the debt even after you got all of your money back out. So the most traditional version of a BRRRR is you buy a beat-up house, you makes it worth more, and you are able to refinance, get all of your money back out, and then rent it. And in our world, 100% BRRRR is pretty rare in markets like Seattle, and that the general consensus is that BRRRRs don't work in high-value markets, that in that mechanism, they work in lower value markets where you get higher cap rates on the rents, and it's harder to make it work in a higher rate market like what we're in now.
It's the renting part for me that would seem to be the hardest.
To get the rent to service the debt. Yeah. And there's a lot of calculations to go into how to do a BRRR. But the concept of a BRRR is, this is why I tell people, people get so caught up in the in-between mechanisms of how to do these investment strategies. They try to learn all these in-between steps. And I always say, start with the end in mind. If you understand what you're creating at the end, then you're filling in the middle with these different steps. And the traditional BRRR method I just walked through tells you one mechanism on how to get there, which if you follow that mechanism doesn't work in all markets or all properties or whatever, right? Mm-hmm. This is really the end in mind you're shooting for. Pretend that you have some rich aunt you didn't even know existed.
Okay.
And then she dies. And you inherit some property that's got a bunch of equity in it. You didn't pay to get it. You could sell it, and you're going to get the equity, the net sales proceeds equity. Or you could say, hey, let's see what this thing would rent for. Oh, look, it will actually cash flow positive, and I like the location. I think it's going to keep going up, so why not rent it, get a little cash flow, let it go up in value while the renter's paying down the debt balance. Imagine that's your scenario. I always like to use this, the rich unbeknownst like aunt that you didn't even know existed, and you just inherited this thing.
Yep.
Fictitiously put yourself in that scenario, and then what do you do with the property when you're done? Right, when you just get the property. What you're doing in your quote-unquote BRRRR strategy is creating that scenario. I'm going to buy a property. I'm going to do something to make it worth more money. Mm-hmm. And then put myself in a tough situation of like, man, I have this property with all this equity and it didn't cost me anything. So what am I going to do with it? Right? That is the recreation of a BRRRR strategy. And when you understand the end in mind, then you can understand there's different ways to come into that scenario versus just buying a beat up house and fixing it up. The problem with BRRRRing is it's very much like flips, in that once someone sees the most natural mechanism that someone talks about, everyone's trying to recreate that mechanism, and it doesn't always work, and the competition for those assets become more tighter, and finding them is almost impossible because everyone's trying to do the exact same thing over and over and over and over again.
Right.
And so that's why if you just go to some basic investor forums, it's not uncommon for people to say, oh, BRRRring doesn't work in Seattle, right? Thatch has actually been out there teaching a lot of people this in his investment strategies, and he's made stuff like this work in Seattle. But there's also like timing of the market, when he did it, upcoming different markets, value adds, rates were lower. It's harder to make deals work on a BRRRR strategy in a higher rate market in all markets. But the general consensus is that it's harder to do in a high value market. It's harder to do in a high rate market. In a high value, high rate market, it's doubly hard. And some people just think it's straight impossible.
It also requires more capital, though, right? Which it can also be a limiting factor.
It depends on the investor.
You're paying more for the house, potentially, right? The rehab is going to be probably more substantial, I guess.
Maybe.
Just buy something small.
Right.
But, yeah, I can see how that belief would hold true.
Right.
So how do you do it then?
Well,
Mr. Smarty Pants?
So the first thing is this. Now that we understand the mechanism for what you're trying to create, let's think about like a perfect end scenario. Let's say you're really good at BRRRring properties and you do it 10 times. Now you have 10 rentals that all have 30, and let's say the ones that you did earlier maybe have appreciated some and you paid down the debt. Mm-hmm. So let's say you have some that you just recently did, they have 30% equity. You have some other ones that you did years ago, maybe those have like 60% equity. And let's say you end up having 10 homes, let's say an average value of $200,000 a piece, okay, and you have an average loan-to-value position of about half. Mm-hmm. So 10 homes, $200,000 value, that's a $2 million value, and you owe $1 million on all of them, and they cash flow.
Yeah.
So one of the other things is people, before we get into the how to do it in a high-value market, let's also just talk about like some of the flaws that some people see in this investing, and then and some of the flawed, I think probably more of the flawed thinking that comes from people who criticize this investing. Let's say you did this 10 times, and people are like, oh, well, let's say it was over a 10-year period. You have $1 million in equity, fine. You have cash flow, fine. But you have some investments that maybe have 10 years paid off on a 30-year mortgage, so you still got 20 years left. And the ones you just recently did have a 30-year loan. Like, what's my end game? So many people get caught up in real estate investing that they see this individual investment and they say, well, what is this really doing for me?
Why is that? I don't understand why that's a problem.
The reason I'm addressing this is because I talk to investors all the time, and I'm telling you that for newer investors in this space, this is what they almost all think.
They're like worried about having the mortgage. Like
they're like, oh, we have this new mortgage, and what's this really doing for me? And now I got to wait 30 years before I have to wait 20 years before the first one gets paid off, and then the last one I buy, I got to wait 30 years. And what if I started this at the age of 50, and then I don't have something that paid off and gives me cash flow until I'm like 80? Like people actually start to run down these rabbit holes.
Got it.
I already know your mind's like, no. I got $1 million in net worth of positive cash flow, right? So here's where I want to correct some of that thinking for some of our listeners. The first thing is this. There's some basic ideas of philosophies to investing, not real estate investing, just investing as a whole. Saying that comment, like, what am I going to do with the investment? It's not going to make me that much cash flow until we pay off the debt, is kind of like saying, how much Coca-Cola stock do I have to buy at their 1% to 2% dividends before I get $8,000 a month in cash flow? Oh, I'm never going to get to enough in my lifetime. Why would I ever buy Coca-Cola stock?
Right.
It's like you're thinking too far at the end game while you're buying a specific asset.
Yeah.
In the most basic world, and this is without me being a financial advisor, I'm just going to walk you through what most financial advisors would tell you. If you're hoping for growth on a safe basis, you would maybe shoot for like an S&P 500 index fund, get around a 10% return. And there's some dividends being paid out, but not a lot. But in general, you invest into investments that you hope to have a growth factor. And once it grows to a certain value, you can always trade it into an investment that doesn't necessarily get as high of a return, but pays you a higher percentage of what you own as cash flow. So there's investments that are focused on growth, and there's some that are focused on cash flow. So simplify it. If someone just hands you $1 million and says, figure out how to get the most cash flow out of this $1 million, that's a good place to start. If you have 10 million, even better. If you have 100 million, even better. The short answer is, if you have capital, you can always trade that for cash flow. So when people say, well, what's this end game? Well, an easy end game is, what if you did that and you said, okay, maybe I'm going to hold on to those, 10 homes that you BRRR'd. And let's talk about two different strategies to how you could quickly convert that to cash flow, right? One is you could say, okay, when I'm ready to retire, I'm going to tax exchange, which is part of a investment strategy, do like a 1031 exchange, and move some of these into higher cash flow investments. This is what in our industry, in the world of investing, we call the capitalization rate, or cap rate for short. Cap rate is like the dividend equivalent.
Yep.
Of real estate dividend returns. It's whatever percentage you paid for the property relative to cash flow you get. So if you BRRR'd properties in a high value market, your cap rate returns might be horrible, but if it pays for its own debt and you have a lot of equity in the thing, you can tax exchange that. So I might have like one rental house in Alki that I'm going to hold on to for 10 years. And maybe I'll have $1 million to $2 million in equity on that one asset, whatever it's going to be. And I could go, and all the people are like, hey, I buy houses in Indiana because I get like a 9% cap rate, right? My reaction is I don't judge those people who are doing that.
Yeah.
Like, great, that's a great cap rate market. I'm listening to you. Tell me how it's a great cap rate market. I might go, oh, okay, well, I'm not going to buy a house or even a multifamily there yet, but I'm going to keep paying attention to where investments I believe are good long-term cash flow investments, sit on my West Seattle Alki house until I'm ready to retire, and then transfer, let's say, $1.5 million in equity and go buy like an apartment building over in Indiana and get a similar cap rate there, maybe even higher because it's a multifamily, right? And I'm trading into that asset where now that cash flow bumps up, right? So over here, maybe I was getting a 2% cap rate. Over there, I'm going to get a 10% cap rate, and I'm going to get the cash flow I want, even if the thing isn't totally paid off.
Yeah.
But there's a transfer of assets that gives you cash flow.
Yep.
The basic summary of this, in the end of the day, you want to get your nest egg of what you're worth as high as possible, and then you can always trade those values into other investments.
Yeah.
But it's harder to go in reverse. If someone says, here's 20 grand in cash flow, net cash flow, hey, that's great. But what if that asset doesn't have a huge lump sum sale price? Let's say that 20 grand in cash flow is something that you can always that you can only sell for like a net price of $2 million. That's a great cash flow return on that value, right? But if you cash in and get the $2 million, you might be like, oh, I'd rather keep the 20 grand a month in cash flow because that's going to be 240 grand a year. Mm-hmm. That percentage is really offset. So you can focus on cash flow, but that's usually a better thing to do at the end game. If you focus on value and you shift it to cash flow, you have more options. You have all these different cash flow investments you can move them to. But if you have only cash flow up front, it takes a while for it to turn into capital.
Yep. I'm going to take us off the rails for a minute.
Okay.
Because I want to talk about this idea of the end game anyway.
Yeah.
I also want to talk about the idea of people trying to do things too fast. What I wrote down was the end game is really just to keep playing the game, right?
Right.
Like Simon Sinek has this book. It's called, I think it's called The Infinite Game or something, right? Life does not have an end point. Like, you do not know when it's going to end.
Mm-hmm.
The goal is just to keep going. And in some ways, you want to just win as much as you can and not end the game.
Right.
Which means lose all of your money or die, really is what these two things mean, right? I think what you are saying, and the reason why there are so many potential different outcomes and ways to go, is because you can define what that looks like for you in whatever way that you want.
Right.
If you want to make a ton of cash, that's fine. If you want to not make a ton of cash and play a longer game and be able to like grow an empire or have, be like a Monopoly guy and have a bunch of properties and do a bunch of stuff, that's okay too. If you want to just have enough to where you can go live on the beach, that's okay too. I think step number one when you're doing all of this is really what you said at the beginning, but is invert, which is start at the end, think about what you're trying to do, and then grab these different strategies that will get you there, either the fastest or the easiest or the one
right.
that you like the most. Whatever the answer is,
yep.
do that thing.
If you can't tell what I'm doing is I'm formulating. Look, we've talked about this. My concept of retirement is not what most of my clients are thinking, but I am setting up the framework so our conversation fits more what people are hoping for from a retirement.
I think we need to tell these people to fuck off. That retirement is a trap, right?
Yeah.
Like, you need to find something that you like to do. You need to keep going. This idea of sitting on the beach is boring. People,
no question.
No one really does that unless they want to die quickly, essentially.
It's funny because sometimes the best quotes I've heard from philosophers, successful people, whoever they're going to be. I'm always sometimes surprised when I hear a quote that sounds really, really elementary from someone who's really, really smart. And then after time passes by, I look back at it, I'm like, that person was a fucking genius.
Yeah.
There was one from Albert Einstein. He said, life is like riding a bicycle. You have to keep moving forward to keep your balance. Mm-hmm. I remember thinking, like, Albert Einstein riding a bike? Like, this is the most, like, I was expecting to, I've seen some profound quotes from, from all these different people, Emerson, whatever. And I remember thinking, like, that's all Einstein has, ride a bike to keep your balance. And then the more I move forward in life, the more I'm like, oh, I get it now.
Yeah.
Like, if you just get off the bike and chill because you thought you got to a place of success, it doesn't make you feel successful.
Yeah.
It actually reminds me a lot of an article I read that was called I Failed at Retirement. It was written by a financial advisor. And what he did is he helped people get to their financial goals for retirement the traditional way. And so he followed those the exact same way, had a big nest egg, did all the things we're talking about, net worth, cash flow, the whole nine. Then he retired, and then he hated his life because he literally deleted his whole purpose for what he was doing. And now he didn't have one.
Yep.
And so in his retirement, he was unhappy. He didn't have purpose. Right. And if you look at people who live the longest and are happy, like in the blue zones, you notice that they have community, they have purpose. They're not sitting around doing shit.
Right.
So Chris is right. I agree with that. But I think that's a different show. We're just going to talk.
It's a different show because it's important. It's important when talking about this stuff as well because it's the reason why people are getting concerned about having a 30-year note on a rental house.
Yeah.
Like this,
they're trying to get to an end game.
They're trying to go too fast as well. It's
right.
It's not a game of speed. It's a game really of compound interest, of compounding what you're doing in a way.
Right.
Everybody has to start at zero, and zero is really slow.
Right.
Think about your progress and your sort of path as a real estate investor. You didn't start with a $10 million portfolio.
Mm-mm.
You started with one. You learned some things. Then you went to 2. Then you went to whatever. Maybe you went back to 1. Then you're like, oh, there's this cool condo, sort of strategy that I have. And then you went to 1 of those. And then you said, oh, okay, well, I'll do 3 of those. And then it builds on itself, And I think in some ways, you have tried to go too fast at some point in time, right? And then you realize if I just go slow and steady and make good choices and follow my sort of investing philosophy, I can go faster over time.
Right.
And I think that when you're doing this stuff, it's really easy to think about when you have 10. Fuck that. Just get the first one.
I agree with that.
You know what I'm saying? Just get number 1. You're going to learn so much when you do number 1. Probably 10x you're going to learn from what you maybe get back in money on number 1.
Well, I think what I represent for a lot of my clients is a platform for you to rethink and reshape the way you see things at different stages. Because almost all the erroneous thinking that I'm referencing, I would say that I have had them myself at different stages. And then you look at it and I reevaluate and I talk to mentors and I experience things. I go, oh, I've seen this wrong. Right. And so just know that at whatever stage you're at, including myself, there's a level where you'll look back and be like, oh, I was looking at that wrong. And the sooner you can course correct those things, the bigger it grows. But at the same time, right, you also will so if you do it right, you'll still have immense amount of success, even if you weren't doing things perfectly, if you just follow some basic fundamentals.
Yes.
But in general, in the world of investing, I would say that it's the most efficient way to get to net worth and cash flow, or a combination of two, is the focus. There's a balance between the two, especially if you're doing leveraged investments like in real estate. But it's usually better that if you can choose, as long as the cash flow services the debt, it doesn't have to be huge cash flow. It's better to focus on net worth early, because it's always easier to convert capital to cash flow. If people could argue with me all day long on this, I'm like, look, pick a cash flow number. Just pick one. I don't care how big it is. $1 million a month. I don't care how big it is. It could be $1,000 a month, $1 million a month. Whatever it is, there's for sure a number where if you said, I'm going to give you blank cash in the bank, tax-free, whatever amount of digits, can I convert that to this much cash flow? The answer is always yes, right? And in reverse, how much cash flow do you need to create that much capital? It always is that with a multiplier of time, less expenses, and living expenses. Right. So it's always like the speed of turning, the speed of turning $10 million in cash to $30,000 a month in cash flow can happen instantaneous. Oh, where can I get a municipal bond that pays close to a 3.6% rate of return tax-free, right? Okay, that's going to turn this investment into $360,000 a year, $30,000 a month. Boom, right? You could do the research in a couple of weeks and find something to put it in, right? But what's the most efficient way to turn $30,000 a month in cash flow into $10 million in cash? Okay, well now I have to figure out all my different options of what I can invest in and let it compound over a period of time to eventually get to that $10 million, which is why work takes so long to build up a nest egg of 7, 8, 10, 9 figures, right? Yep. So it's always easier to convert capital to cash flow. And I think that's one of the first lessons to this, which is why we even want to talk about how do you do a BRRR in a high value market? Why does it even matter? Because if your BRRR investment you do in Arkansas, not you specifically, but whoever I'm talking to, creates 50 to 100,000 in equity, and I could do one in Seattle that creates 400 to $1 million in equity, then years down the road when I'm ready to trade my capital into cash flow, I got a way bigger number to work with than you do. And the cash flow I will get from that conversion is way bigger, right?
Yeah. Okay. So let me play devil's advocate here.
Okay.
In that example, though, the property that you're going to find in Seattle is going to be probably a lot harder to find, right? It's going to be a little bit more scarce because you're going to have to be a very specific type of property.
This is different. It's a different playbook.
You're going to have to put up more money, because it's going to be a more expensive property. Right?
Yes. In general, when you look at like the percentages of a deal, sure, right? But I would also say that the margin of risk isn't always more like people think it is, because sometimes some things are relatively same in cost, and so the margin it creates in value is less. Like end of the day, like if I'm going to buy a property and do a bathroom, let's say here's an example. Let's say it's the assets are exactly the same in two cities where the assets can look similar. Let's take a 1,500 square foot craftsman home in Tacoma or in Seattle. Both are older cities. Both had craftsman homes, right? Similar condition. Mm-hmm. The material we're buying for both of them is the same. Now, those are similar markets, so the labor is going to be similar too. And you could argue that when you get in cheaper markets, the labor costs can drop, but material costs don't really vary from state to state. Like the cost of a vanity that you buy at Home Depot is going to be the same in Arkansas as it's going to be in Seattle.
Maybe.
It is. It's online. Like the material is relatively the same. Cost of lumber is the same. Like you can see the commodity price, what it trades for, right? There could be small variances here and there, but they're pretty similar. Material costs are pretty similar. Okay. And so when you do the exact same thing, I'm going to, in general, if the work you're doing is the same, the margin of what it does to the value typically is much higher on a higher value property. So if I'm going to update the kitchen, update the bathroom, replace the flooring, like when I go to Costco and I see that they have LVP for $2.19 a square foot, it's going to be a similar cost in New Mexico. And I can use the same flooring in Seattle as I would on a property in New Mexico. But if I change the flooring on that craftsman home in like Ballard, right, that's going to have a much bigger impact to that value of that home than it is going to be in New Mexico, which is one of the reasons why two of the biggest single family investors in the whole country are in my market. Like Thatch and James Daynard are revered as huge investors in the investor world in the single family space. And they're in the same market, buying assets in a very similar market. I remember commenting on one of James's posts he put on social media where he was talking about why he invests in Seattle and he thinks Seattle's still a great market to invest in. Because people are thinking like, oh, well, there's already people doing ADUs here and whatever. I'm like, if you understand how the game really works, it's going to be a long time before Seattle's not a good market. Because here's what makes Seattle a good market. A, there's a lot of value for jobs and the properties, right? Mm-hmm. B, it's an older city, which means there's lots of old houses. They were a city that was small back in the day and bigger now, like let's say Bellevue, is a harder market to invest in because a mid-century home built in the 1960s doesn't have as much room to be value added than a 100-year-old craftsman. And so when you get the city that the houses were smaller, which means that you can maybe add a backyard cottage or build another house or tear it down and build something bigger. There's more of those to do that with. The homes that were built in Kirkland and Bellevue, it's like there's downtown parts of Bellevue and Kirkland, and there's still some little houses littered around, but the majority of the houses are newer and bigger, and so scraping it down and adding a backyard cottage is a lot harder to find those. So Seattle, it's a combination of lots of, like when the city was developed, has just this, it's littered with a whole bunch of crap houses in good neighborhoods. This is the whole city of Seattle is. And it's going to take a long time to work through all those assets and maximize their value. And also think about how like the backyard cottage, like the ADU play that's happening in Seattle. We talked about this on the HB 1337, 1110 episodes. They're not just a whole bunch of little crap houses in all these different neighborhoods, including nice neighborhoods. They're also predominantly done in this neighborhoods that were in the old tradition of doing neighborhoods, long, skinny alley lots. So they have double ingress, which means if you have a whole bunch of little houses on alley lots, you have a whole bunch of backyards that you could build another house and have access to it from the alley. So it's easy to say, oh, well, if I took this property, cut it in half, and build another house in the back of it, there's this extra street access to it. You've been in Kirkland, you live there, right? I have rentals there. It's like the only part of Kirkland that has alleys is downtown Kirkland and some of Houghton, and those neighborhoods are really small and super expensive. So you're competing with all these huge builders. It's a nightmare trying to put a deal together in those neighborhoods. They're just, the city was so small 100 years ago when they did those kind of neighborhoods, and all the majority of the neighborhoods are suburban, built in the 50s and 70s and whatever. And that 50s, 60s, 70s construction, although it's not ideal to like today's new construction standards, are still nice enough that you wouldn't want to scrape a 2,000 square foot split entry home to build new. It costs too much money, right? For a lot of them. Some you do, but for a lot of them, right?
Yeah.
So,
all right. Let's talk about.
Get back on track on the high value BRRR. I wanted to get into like why is high value BRRRing important? Because if I BRRR 10 houses in, let's say, Seattle, and I have an average equity position of, let's say, $400,000 equity, the equity position, and I do 10 of them, I now have a net worth of $4 million. Maybe after sale proceeds and taxes, I would net like $3 million. Okay, and that $3 million you can do a lot more with than if you did the same thing in some other state, like we use as an example, where it's $1 million in equity. Maybe
what if you took? Yeah, but I think I think that the math is not computing, because if you took the same money that you were going to use here and deployed that somewhere else, instead of having 10 houses, you would have 30, right? because your
it doesn't
single house cost here is going to get you 3 houses like in Arkansas.
That makes sense, but one of the problems is that here's where the scaling problem happens in low value markets. The first thing is this is all these strategies are active investment strategies, which means your own personal time will go into it. So my argument to that is very similar to, like, let's talk about like a cost of goods business. Cost of goods business is a function of like buying something and selling it for a profit. And you can't just pay attention to margins because there's a volume and time, energy to do volume that applies.
Sure.
You could buy a bunch of shit on a bunch of garage sales and find ways to sell it for 4 to 10, 20 times on eBay. But how much time did you have to spend to get all those moved?
But I think there's also a little bit of incorrect assumption. Like in Arkansas, that $200,000 house, or let's say $300,000 house, is the equivalent of an $800,000 house here, just because of the market, right? Like in Kansas, for example, you can get a bomb house for $1 million. Will get you a $3 million house here. Mm-hmm. Like it will be on a huge plot of land. It will be a mammoth house. It will have a pool, right? You know what I'm saying? So I think, and I'm not saying that you can't do it in high value markets. I just think it's harder because making the math work is harder, right? So let me ask you
this. The business plan is different.
Let me ask you this to sort of, because I think it's doable. I'm going to have you tell me how it's doable.
But before you do that, let me close. There's two ideas as to why the scaling doesn't work. One is like ROI of time, even if your margins are there. The other one is, as a mortgage lender, it's not easy to get more than about 10 rentals. Like Fannie cuts you off at 10, Freddie cuts you off at 10, and it's not 10 each, it's 10 combined. There's strategies around it. I'm married, my wife takes one, I take one, right? And there's some commercial loans that you get to put the properties in LLCs as long as the title and the note is in an entity that doesn't count towards the number. So there's strategies around it, but those loans are harder to find. They're usually done by regional banks for that market, so you have to really research your specific market, who's going to do that loan for you. Yep. And then there's some also non-QM products that allow for more units, but they cost more. But the short answer is the minute you go past 10, if you're single, you're still making accommodations on the investment. Now you need more equity, more cash flow to accommodate for these different terms that these banks need. And it just, you hit a brick wall at 10. So I don't want 10 little houses in Arkansas, or I want 10 higher value assets in a higher value market, right?
Yeah, yes, that's fine.
And there's a trade out process that you can deleverage them, move those into apartment buildings, and then start over again. But if you personally have to actively work on the deal to push up the value, manage the team, manage the remodel, manage the numbers, get the refinance, get your money back out, rinse, repeat. If I'm spending my own personal time on this, how much does that move my needle of my net worth? And when do I hit a brick wall on my growth scaling because of things like financing?
Yeah, yes. I just think that there's a bunch of different moving parts when it comes to like what your ultimate goals are and what your ultimate speed is.
Sure.
Because I think for the most part, for example, this conversation should be tailored probably to somebody that's trying to do like their first one or their second one.
Sure.
You know? So it's really like, let's say you live here in Seattle and you're like, I'm scared to go somewhere else. I want to be able to touch my property. I want to be able to see it or whatever. Right. I want to be able to be hands-on and not have some contractor, whatever, steal all my stuff. So let's take that person as like the character in our story looking for a high value area BRRRR.
Right.
What are we going to be looking for? I think you've already said some of the characteristics. Older, right? Yeah. Is where you're going to kind of want to start, right? Mm-hmm. A place where you can add value. Tell me about that.
Yeah.
Step one.
Yeah. So yeah, I think we spent enough time talking about why is it important to do it, right?
Yeah, no, Look, if you don't think it's a good idea to do it, you're listening to the wrong show anyway. So
right. Let's just face it. Like there's an idea of like maybe someone could BRRRR cheap houses in a different market and catch someone else in a cash flow net worth number. But in reality, watching people do this over and over again, when I see people do really, really well, and I've seen a lot of people's portfolios that runs for lots of people who focus on markets that they have a deeper understanding on, which we had shows talking about that, why people are successful with real estate leveraging it, because they're not buying shit they don't know what they're buying into, like they could be in stocks. They really know their areas. That's another reason why local matters, right? Like when you mentioned Kansas, I think that if you wanted to do a little bit of both markets, it's like cool because you live here, you grew up in Kansas, so you know both.
Right.
But for a lot of people, they just, they've only lived in one area. So even if that, I would argue that even though we're going to talk about how to BRRRR in a high value market, I wouldn't go jump from Kansas to go do this in Seattle and you have no idea what the Seattle neighborhoods are like. It's like maybe you should do some local that you really feel confident about your locations and so forth, and then spend some time really studying the market you're going to shift into, right?
For sure. You wouldn't just want to probably rush into this no matter what. I think, though, at the end of the day, the message should be to start taking action, period.
Yeah.
Like, you're going to have a step one. Like, just start. And I think whether you do it here or whether you do it anywhere else, all of these strategies will work over time. And as you do them, you will gain more experience. You will also become more sophisticated, and what you do will probably change.
Yeah.
If you do a couple in Arkansas, for example, you may say, okay, I don't know how to do this. Mm-hmm. Let's go bigger. Let's look local or whatever. Or vice versa. You may say, I've done a couple here. Let's go do 5 at a time or something. I don't know. But the key is not to be too, for me at least, is not to be too worried about what my 10th house looks like. Get your first house.
Right.
First.
But I do think that every time you start to do your deals, sometimes when people have a success, they just try to rinse, repeat again and again, which I think is fine. But there's like, if they don't take time to evaluate what their path is, because I see this all the time with my clients, they're going 100 miles per hour towards a brick wall. They have no idea they're about to get to a halt.
Correct. Yeah, right. But I think that just goes back to what we were talking about earlier, which is you need to think about what you're trying to do anyway.
Right.
You do need to know what the point is. Mm-hmm. Do you want to be a real estate magnate? Do you want to have time freedom, location freedom?
Totally.
What do you want to do? That's going to help drive each of your successive decisions. I think no matter what you want to do, though, there is a first property that you need to get.
100%.
You know what I'm saying? And what like that first property, unless you're just an idiot and do something terribly wrong, it's not going to bankrupt you. It's not going to destroy your, lifetime financial status. It may not go great, but you'll be able to learn enough to move on to the next project and do a little bit better. Learn you don't like. You could do a BRRRR and be like, this sucks, man. I don't like this.
Yeah.
I'm gonna do some condo strategy. Or I'm gonna do whatever.
Well, and yeah. So we'll use that as a segue. So what's funny is that as I say this as my own criticism, I've not done any out-of-state lending. Have I ever done a traditional BRRRR, where you just buy, rehab it, and then keep it? I actually haven't. I've wholesaled one, so I've gotten a fee moving it to someone else who would then do it. But the things I'm going to talk about how to do my high value BRRRRing in the non-traditional way was something I was already good at. So I just knew not to mess with the other ones and not get sucked into what other people are doing. I know what people are hoping for is that their value add is in a traditional remodel, and I'm going to do some flips. And then maybe if the property meets it, I'm going to do some BRRRRs. I'm going to go back and forth between the two. Mm-hmm. If I'm creating value into property for a fraction of the cost, whether you buy a property for 40, put 40 into it and sell it for 150, which is like a flip, or buy it for 40, remodel for 40, remodel it as an $80,000 loan with a value of 150 and BRRRR it, there's still this value add aspect that most people think only comes in the form of buying a piece of crap property and then fixing it up. I do feel that aspect does definitely exist in most of the properties I've bought, but the key is that it's not my only play. So
yeah, but yes, I agree with you. I think your play though is way more sophisticated than most people are ready to handle.
Maybe, but there's also a perception to it too.
Yeah, but I think you can find a house like let's say in Ballard, for example, that's 100 years old. It could use an upgrade in materials just across the board, and that would raise the value enough that you could employ this strategy.
Mm-hmm.
You know, it may take you a while to find it because there are a lot of other people that are looking for that exact same thing.
Right.
Mostly you're not only competing with investors, but that's what a normal property owner would want to do too.
Right.
You know, find something that's like a little fixer-upper, fix it up, and live in it.
Right.
So there is competition there.
I think the key is that you can recreate business plans based off specific markets, and we'll get into that. So how do I BRRR things in a high value market? Now that we've talked about the traditional way of BRRRing, right? What I do is not a traditional version of BRRRing, and I think that most BRRRR investors will say, well, that's not really BRRRing, right? But good, like look at what I'm doing and criticize it, and if that's your reason for not doing it, that gives me a reason not to have competition. But in general, there's a way to avoid competition and continue to do it. Because we all are doing the same thing, which is with the limited amount of resources, how do you try to get the most ROI doing the stuff you enjoy to do and get the financial return you want out of it, right?
The difference for you is going to be how you define rehab, right?
Right. Value add.
Right.
And so I think one of the key things on how to try to make a BRRRR work in a high value market, there's two things you're trying to overcome. The higher price means usually lower cap rate, and also higher point of entry, all the things we talked about. And so there's ways to turn those things to your advantage. Like there's just because somewhere is a high value area, higher point of entry, higher price point, higher principal balance to try to offset with a higher interest rate, doesn't mean that you can't use that market reality against it. So how do you do that? The way I do it is through development. The key is that. And now that sounds really hard, but we already had episodes talking about HB 1337, HB 1110. That's why this is so relevant, right? We are a high value market in Seattle, and there's housing bills. We already have favorable development code as it is, and it's about to get even better. So how do you BRRRR something? Like I showed someone a property last night, which I'd have to look, but from what I could tell, it would probably have a version of it cash flowing pretty close to even if you did that deal. But it was a split entry home on the east side. The owner, probably not the best investment, but didn't really matter. It's an estate sale. Built a 1,200 square foot single story garage that, for the most part, looked just like a house, other than instead of having
garage doors on it, probably, or something.
Big garage door, which easily could have been a small garage door, a window, and a front door.
Right.
But it's got the normal roof pitch. It's got the same architectural design as the house next door, and it's not some garage tucked in the backyard or whatever. It's literally like house on, like here's the front of the house. Directly next to it is this structure that looks like a rambler too close to a house, but it only has a garage door, right? And I did some research. It already had insulation and power and its own panel. It was on the properties on septic, but there's sewer at the street. And I'm just doing my numbers on it. I'm like, I've connected properties to sewer in this district in North Shore. And I'm looking at the elevation. I'm looking where it's stubbed out. I'm like, yeah, this sewer connection, if we did it for both the house and this garage, would probably be somewhere under $35,000. And I know that the city in their development code and that garage is basically the max size of what you can do an ADU on. And so I'm looking at it, I'm like, okay, well, if I turn in an architectural plan to design the garage to be converted to an accessory dwelling unit, and I condo it, and then I do all the utility connections and then make it to another house, the whole property is being sold for around $1 million, right? I should be able to sell that property next door that I just created for about the price I paid for the whole thing. So if the thing is purchased for $1 million, and between remodel, utilities, and all that stuff, maybe it's 300 and condoing it, I'm $300,000 into it. So now I'm into the property for 1.3. People are like, oh my gosh, 1.3 for two houses is still too expensive, although it's a lot cheaper than what a house in that area normally costs for if you cut it in half, $700,000 a piece. The way you flip it on its head and make it work for you is, okay, well, I'm going to dump one of them now. I'm going to dump the one that would get the lower rent, which is the Rambler. And then the split entry home, which has more bedrooms, will get the higher rent. I might even turn it to an upstairs, downstairs space and rent it this too.
Yep.
But if I end up keeping that one for a loan balance of, let's say, after selling costs of the other one, let's say $450, could I get enough cash flow if I rent out like a duplex, maybe like a traveling nurse downstairs and a regular family upstairs, that would cover a $450,000 debt position? Now I have $1 million split entry home. rented like a duplex that I owe $450 on. All my capital invested is back.
Right.
But in the BRRRR strategy, there was a sale to deleverage the investment. I was explaining this to my friend Justin last night. We had, it's probably like a 50 text messenger thread, and I'm walking through how to do this, right? That high value area, the whole misnomer about like how high value makes it impossible, worked for my favor, because in that market, people are going to pay $1 million for a Rambler. And when someone already built something where I'm already 3/4 of the way there, I could just sprinkle my fairy dust on it, sell part of it for $1 million, and then I get to keep the other retained asset for a fraction of the cost. It's a term I've coined myself. I call it a BRRRR. My friends know this, right? My friends laugh when I talk about it. But I'm creating an extra unit in the mix that wasn't there before.
What's the F stand for?
Flip.
Got it.
Right? Yeah. You're going to buy, rehab it, right? You're going to rent part of it. You're going to flip part of it. And then you're going to, and then rinse and repeat, refinance, repeat, right? But I'm getting my capital back.
Yeah.
Not from just a refinance. The refinance is really just to pay off the bigger loan I had originally. Take the sales proceeds from the flip. Take part of the proceeds, pay myself back the money I put into the property, and then refinance the remaining debt of a much smaller debt, and rinse repeat, right?
The difference here is when you're talking about rehab, you're not talking about replacing the floors, updating the bathroom. You're talking about rehabilitating the character of the property so it has more value.
Yeah, almost you use that R as like repurpose.
Yeah.
Right? What's repurpose highest best value?
Rehab still stands for rehabilitate, so it's the same thing.
It's
You're still fixing something that is not at its highest and best use at the time.
Right. And look,
that second dwelling.
It could be as simple, like in this strategy, it doesn't even, in that one, I'm taking a partially finished structure and then turning it into another dwelling. It could also just be building nothing from the ground up. Or it could just be, I bought a fourplex that's worth 40% more as condos, and I dumped 3 of the 4 and kept the 4th one the same way. But it begins the strategy. Now, if you think conceptually, if I did this 10 times, right, I could have 10 rentals the same way. But there's a problem with that, right? If each one of these is its own form of a condo association or subdivision, there might be HOAs and CC&Rs, and now I'm part of like 10 HOAs. It's a little bit of a nightmare, right? So if you think about conceptually what might happen in later stages is this. You're leaving equity in a deal. And what will determine how much you do this also has a lot to do with what's happening with rates. So like this strategy I'm going to go into next is a little bit harder for me because moving forward, because I bought a bunch of stuff when rates were lower. And so doing this strategy moving forward with rates are higher, it's harder. But one of the strategies you could do is say, let's say rates are relatively the same between the acquisition of property 1 to property number 2. Okay. Instead of doing the same BRRRR on the next one, what I could do is say, okay, if the first one was kept for a rental for a year and I have my capital back in the bank, I could go find another deal that was very similar. And now I could choose when I see that next one to rinse and repeat the exact same process. Or maybe I'll get that owner to allow me to buy this thing contingent, sell the first rental, and then move that permanent equity in the first one into the second one, right? Which now I'm going to just trade 1 for 1, do the exact same development strategy with my temporary capital, turn that into 2, and then cash out, refinance that, and then just keep those 2 because I'm moving. And if I did the same thing, I bought the split engineer home, made the Rambler next door, sold 1, kept 1. A year later, I buy another asset like it, and I do a 1031 into that asset, and it creates enough equity in it that I can keep those 2 because I traded into it. Now my 1 becomes 2, and I'm not part of 2 associations. Right? I own both sides. And then whether I rinse and repeat the same add 1 or 2 to the strategy or I start doing trading, the same thing is still occurring. Whether in a traditional BRRRR strategy, if you're not doing any development, if you did it 10 times, you get 10 houses. Well, how's that any different? If I turn 1 property to 2, 2 to 4, 4 to 8, I still get to the 10, but I've done it in this high, and the same things work to my advantage. Oh, well, there's such a high value market. Well, if I had an asset for 4 years, create $500,000 in equity, and now it becomes $800,000 in equity, and I trade it into a similar asset that could be where I could add an extra unit to it that not only is an extra rental door, but a sellable unit, it creates all this higher resale value. It still adds to the portfolio. So either in a form of adding, developing a unit and then selling a piece of it off, which is like a BRRRR, or once you already have some units in your portfolio, doing trades, right? But as long as you're always buying value adds that you can create extra units for both cash flow and saleability, right? It adds a lot of value. And in a high value market, all the high value things that we're talking about work to your advantage. Because when you build a little house in an expensive market, you still get this huge cost per square foot. This is why detached ADU construction, as hard as it was to do in Kirkland, is where I focused on instead of when everyone was doing them in Seattle, was because the Kirkland ADUs have a $750 to $1,000 per square foot for finished product versus $500 to $700 in these ones in Seattle.
Right.
I didn't want to be a professional builder, beating up my subs to minimize all my costs. I'll still do that to the best I can, but I got a full-time job. But if I have a completed value of 20, 30% higher for the same work, then I could still pay a builder. They can make a little bit of money on it, and I still have my margins.
Yeah.
Or sometimes, like what I just did recently, I did that very thing. We bought a property, we condoed it, did a little remodel to the existing house, sold the house for the same price we paid for it. So we're only out the remodel costs plus the cost of condoing it and the selling cost. So we're into it like a couple $100,000. Got the other yard to be permitted to be built into like $1 million to $1.25 million house, and then we just sold the lot for $350,000. We didn't even build. We just sold the dirt with permits, right? We could have made more money seeing it all the way through, but my partner wanted his money back. He's like, hey, I want to focus on a different kind of investment. Great. So we just sold the dirt and then made a couple $100,000 on just the dirt. And to get that much money out of the dirt is because that person who's going to build it is going to be achieving a $750 to $1,000 per square foot finished product. So they're okay paying that much for a very, very small lot because it's already permitted and they can see the value of what's being done. This is the advantages of doing things in a higher value market, is because you just get a higher return for the work. I still got to work with surveyors. I got to deal with the city permitting. The ROI on my time, and this is part of the reason why literally the whole thing works. Working with municipalities to get things to permits and doing remodel work requires time. I want a better return on my time. And so if I get a higher net number on that work, then it just helps me get to my goals faster.
Yeah.
But really, it's not. I get it. I'm not doing traditional burring, and people will criticize me by doing it. But I'm telling you, this is for sure. Like, as much as they don't talk about it in detail under short videos, James is doing it, Thatch is doing it, I'm doing it, other people in this market are doing it, right? And playing in this higher value marketplace means that you can create these higher net worths and higher capital trades, which if you ever trade into these lower value markets that have higher cap rates, after you've established that capital worth, you get to have your cake and eat it too. I do not ignore any investor who tells me a great market with high cap rates and cash on cash returns. I actually take a lot of interest in it, because the more I establish high value, high equity position investments, the more I want to know, hey, there's points I might want to convert part of these assets into stronger cash flow positions. And when that happens, those markets that they're referencing, the reason why, I will likely trade into them.
Yeah.
The other thing is, so part of it is the development piece, and then selling off parts of it. That deleverages your investment on high value markets. That way you can do the BRRR and make it cash flow work. And the other part of it is taking on non-traditional rents, right? Even if you did all those things, like I kind of said it quickly in that one deal scenario, right? Even if I only have a $425,000 to $450,000 debt position on $1 million house, which means that you have over 50% equity, it's with high rates, it still may not cash flow.
It's tricky.
It's still tricky.
And with property tax, when you add in
taxes, insurance, capital expenditures, and maintenance.
When you add in your annual sort of nut,
right,
it can be tricky.
That's right.
To make the number.
That's right. And so it could be that, hey, if I just rent that house as a regular landlord, that may not work. But maybe the rent of the whole house maybe would be $3,500. Maybe the rent of the upstairs as a 3-bedroom, 1-bath upstairs would rent for $2,900. And instead of trying to just get the extra $600 for the downstairs basement, I turned that to a furnished Airbnb studio, and then I get $2,000 a month for that Airbnb studio in addition to the $2,900 upstairs, and then now I have maybe a mix of the two, and that $4,900 on that $400,000 of debt position, even with a high rate, will then cash flow.
Right.
But it still requires you to take on an extra hat other people don't do. So my extra hats in these scenarios are: I play developer, I deleverage through selling parts of it in BRRRRs and trades, and I'm okay being a landlord who rents things in non-traditional ways to be able to offset the higher rates and the lower cap rates in those specific markets. And some people argue like, oh, it's more trouble than I think it's worth. I'm like, hey, having half a dozen rentals in Kirkland and 1.5 dozen of rentals in West Seattle, which are all high value markets, right? means I get the job growth, I get the appreciation, I get these huge amounts of equity in those markets, right? Yeah. And I'm not saying everyone needs to follow that playbook that way. There's different ways to get abnormal rents. There's room renting, there's adult family homes, there's all these other things. But the point is that if you add a development aspect where you're willing to do trades and sales of part of those units you develop, because think about it, builders will build a bunch of houses and then make a lot of money, but that's literally their job. They live off that income. And if you do a small percentage of that as an investor, and you try to retain assets, the problems that most people have is that when they're a hold person, they don't want to sell anything, and because they aren't willing to deleverage, their growth doesn't happen. Mm-hmm. And then the people who do want to sell only want to sell because they want right now cash and not thinking long term. Right. And very often the best answer is an in between. Do a little development, hold when you can, but always trade if it's going to trade into your growth. More units, more value, more rents. Yep. And so never being too attached to anything where you're always willing to let things go, whether it be part of the asset you just bought or part of something you already own. And you just have to kind of evaluate that as you move along in your investment career.
Yeah. I think to summarize a little bit in my own words, what I would say is this. I think there's opportunity to do many different strategies in almost any market if you are willing to be a little creative and or just take the time to see what is in front of you and start figuring out how you can make things work. Right?
I do think people over calculate how hard it is to be a developer versus being a great manager of subcontractors. I actually think it's easier. Now, everyone's skill set's different, but to get your remodel costs and timelines done on a very big remodel at a minimum cost requires a lot of homework and work done ahead of time. So you have the best flooring electrician guy who's going to do things for, getting used to doing certain things at a reduced cost. Like, for instance, I'm going to buy, appliances from the Habitat of Humanity store and the Best Buy outlet store. It saves me 20-30% across the board whenever I have to get appliances. Great. That multiplied many times over helps you with your margin basis. That took research. Yeah. Well, that research could have been what markets to have a favorable development code where the existing assets already look perfect for developing. Just like when Nicole's on the show and we talked about Mount Lake Terrace, that whole city's littered with tiny houses that we could just turn into the ADU on a site plan and build a full-size house if there's an ingress on the property. And that whole city's littered with it. I already have it from the city. I emailed them and they said they're going to adopt HB 1337 by the summer of not 2024 but 2025, right? Well, no one's going to buy stuff right now. No one's thinking that far ahead. Right. But if you have a tiny house in a different city with a higher rate and you have an opportunity to tax exchange that into that one in that city where you could build an extra house and the other one you can't, then do the trade. Yeah. Right? If if I have a rent, I don't want to sell this rental house because it's making me cash flow of $400 a month and has a lower rate. Well, if you did a tax change into one in Mount Lake Terrace and the cash flow drops from $400 a month to $100 a month, like, oh, wow, I'm going to lose $300 a month of cash flow. Like, you're missing the bigger picture here. Right. You can't do more with your property than just let it ride. If you tax exchanged it into another asset that has that value add aspect into it, now you're getting an entire extra lot. And you can start working on the site plan now. And then once they adopt the code, you can turn it in, get your permits, and then boom, you just got a lot for a 2,500 square foot house for free at the cost of a higher rate and a little bit less cash flow. Yeah. And that bigger picture is what people miss on. Right. And yes, is it hard? Yeah. I'm not going to act like it's easy, but is it harder than finding a flooring guy that will install things at $1.75 a square foot who's not a legal immigrant? But you give him enough work and he's giving you, that's just as hard. Yeah. Find that person and making,
Yeah. I think any strategy that you're going to employ, whether it's in real estate or business or anything, is going to be hard. Yep. Especially at the beginning. You're going to have to learn how to do it. It's not easy. Mm-hmm. If it was easy, everybody would be rich. Everybody would be a real estate investor. Everybody would be a business owner. The reason that everyone is not is because you have to do, and it's not even that it's necessarily hard, it just takes work. You have to be uncomfortable. You're going to be doing things that you've never done before, and it's going to be anxiety inducing in some ways because it's new. Right. You're not sure.
But like we talked about before, is it going to be newer than a person who has never owned a car before but now owns a car for the first time? Like,
it's not. But I
or
think
become a parent for the first time.
Yeah, I think the step into a new car is easier because there's less risk in that you kind of know what you're getting, you know. But
well, if you've already been a car owner,
new.
I'm talking about like when you become a car, like think about like a teenager who's never had a car before in their life, and they're like, hey, you're gonna have to buy your own first car. You have to get used to rotating tires, oil changes, replacing the gas, pay for your insurance, all those things. And you're doing all of it on your own without the help of your parents. That's a big endeavor.
Sure.
You know, oil changes every 3 months, rotate your tires every couple of oil changes, right? Tune-ups to 60, 90,000 miles, right? Like there's a lot of reoccurring maintenance that happens in that commitment that when you haven't done it before is kind of a big deal. And similarly, if you don't know what you're doing, you can go to the wrong place. They can rip you off, just like you can with contractors.
For sure.
Very similar. Yeah. It's very, very similar. We're just totally committed to being car drivers, and not everyone's committed to being millionaires.
Right.
Just like the parenthood thing.
Yeah.
Right? Just like the parenthood thing.
Yeah.
But I guess what I'm trying to also say is this, is that most people think that the development side has more risks or costs than it does like the traditional HGTV fix up an old house. Mm-hmm. That makes for better television, right? They're not making television where it's like, hey, let's look at this piece of land with this tall overgrown grass. And then we took out a couple trees, piped in some sewer from 40 feet away, right? Mm-hmm. And then subdivided it. And the only thing difference is that the public road in front of it clearly was dug up and then repatched over, right?
Yeah.
And a couple trees were removed. And you're like, ta-da, I just made this thing worth 4 times what I paid before. But on a TV show, like, what fucking looks the same?
Right.
That doesn't make for good television. Yeah. But it definitely makes for value add, right? And my point is that gets overlooked way too much, way too much. And I think that the real secret sauce to be able to do value add is to be able to do a little bit of both. You don't have to be great at either one, but just be committed to a little bit of both. Yeah. And people say, oh, but it's going to be hard to find that property. I guarantee you bought something at the cheapest time of the year that if you weren't looking all year round, it could be a pair of socks, it could have been a television, it could have been an air fryer on Black Friday. You put some effort into buying something where you got this ridiculously low price. I got a stackable washer and dryer at the Best Buy outlet store for $425. Those things normally cost $1,200, right? Maybe that's the best deal of the year for that product. Maybe someone else bought another one for $200, right? Whatever, it's that law of attraction. If you actually made an effort and looked for it all the time, you would find it.
Yeah.
Right?
Yeah.
But somehow people talk themselves out of it. They're just too afraid.
Yeah.
So they say it's too hard to find, but it's really not that hard to find. Not relative to the other things that they find.
Right. Yes. Get started, I think, is the key.
Yeah.
All right. Okay. Right an hour, man.
BRRR.
Wrap it up. BRRR for life. All right. So that was awesome. That was good. Any parting words before we go?
You know, if you want to know how to BRRR a deal, hit me up.
There you go. Perfect.
Yeah.
All right. So that is it for today. I am Chris.
I'm Keen.
This is the Business Barbershop Podcast. See ya.
See you guys later.